So what are the best personal loans that are available for those that have bad credit here in 2020? For most that have bad credit, getting a loan seems like it could be very far-fetched. But the bottom line is, even though you have bad credit, there are still companies out there where you can get a quality loan with reasonable terms. So in today's video, we're gonna talk a little bit about what these bad credit loans are, and we'll talk about some of the things that there are to look for when it comes to getting a loan when you have bad credit. Hey everyone, it's Mike Adams here with The Simple Dollar, where we believe that personal finance doesn't have to be difficult. And we're here to help, so definitely visit us over at thesimpledollar.com. We actually did a full-on article. It's actually a very deeply detailed article all about the best loans that you can get your hands on if you do have bad credit. So we'll break down some of those details here, but not all of them in this video. So make sure I'll put the link in the description of this video. Make sure to go check out the full article later so you can get all the details, and as well learn about some of the different companies that are offering these loans with the best terms and the best rates, because we've done a ton of due diligence. Again, you'll be able to check that out over on thesimpledollar.com. But in this video here, what I want to do is really just cover what is a bad credit loan and what does it take to get one of these bad credit loans. What are some of the things that you need to look for in a loan to make sure that you're not paying more than you need to borrow. One of the tough things about loans, especially when you have bad credit, is the fact that it is tougher to get a loan with bad credit. Doesn't mean you can't get one, but typically the terms are going to be much more unfavorable. You're going to deal with higher interest rates, potentially with fees, potentially with annual fees, based on you having low credit. So obviously to remedy this, let's work on fixing your credit. And there's plenty of training right on thesimpledollar.com and here on this YouTube channel as well, with all types of different strategies and training that you can use to better your credit score. If we can better your score, then you'll be able to qualify for better terms. And over time, that's gonna save you a ton of money in interest. When it comes to loans, for many people, large expenses like remodeling a property or even buying a property, most people are going to have to get a loan to finance that purchase. Most people are just simply put not able to buy their primary residence in straight cash. So you're gonna have to get some type of a loan from a lender. So can you do it though still with bad credit? Yes, you can. So let's break down what that looks like. So you may be wondering right now, Mike, I don't even know if I have bad credit. I know my credit score, but is my credit score considered bad? And so there is a scale for this that I'm going to share with you. Again, it's fully detailed in the article over on thesimpledollar.com. But in short, if your credit score is below 650, okay, when you get above 650, that's considered fair credit. Everything below 650 as far as a credit score is considered bad credit. And so if you have a score below 650, yes, you may still be able to qualify. It's going to be a little bit tougher, right? Not all banks are going to lend to those that have bad credit, but there are banks that will. It's just going to take a little bit more due diligence to find the right banks to work with. And again, we can help you out with that. But to give you the rest of the numbers, fair credit is about 651 up to about 700 credit score. When you go from 700 up to about 759-ish, that's what we call good credit. And anything above 760, we consider excellent credit. And with that type of credit score, you'll be able to qualify with many more lenders, but as well, you'll be able to qualify for lower interest rates. Many times with banks, the interest rate is based on the perceived risk that they're taking in lending you the money. And so if somebody has a really good credit score, the risk is low that they're not gonna pay the bank back. Okay, so whether or not you've had a history of bad payments with other loans or lines of credit, if your credit score is simply low, that's how it's gonna be perceived. Like, hey, there's a lot of extra risk here that they may not pay us back. So to compensate us, the bank, for that risk, they're gonna turn around and charge you a higher interest rate. So that's how that works. And some of the different ways that you might use a loan, again, if you have bad credit, here at The Simple Dollar, yes, you can go ahead and apply for a loan, but we highly encourage you to focus on increasing your credit score so you don't have to pay such heavy interest charges. But regardless, there may be some scenarios where, look, you know, even if you have bad credit, it's like, look, I need to get a loan for these kind of reasons. It may still make sense for your scenario to go ahead and get a bad credit loan. And some of the things that people will use, or some of the common uses for personal loans, would be like paying off high interest credit card debt. So if you have a ton of credit card debt at a much higher interest rate, you know, a slightly lower interest rate in a loan, which is still high based on bad credit, but lower than your credit card interest rate, you know, consolidating those higher interest debts into a lower interest rate debt could save you money in interest and as well make it easier for you to pay off the debt. So for consolidating, that can make sense. Perhaps you have a home improvement project, or you're paying off medical bills, any type of emergency expenses. Perhaps you have to pay for a wedding, or maybe you're refinancing different loans. You know, covering moving expenses, or even starting a business. Which would definitely add some risk to your business because you're launching it with a loan with interest. However, it can be done. And in some situations, I've known many entrepreneurs that have taken out a loan and have been able to grow and scale their business and pay off the loan in short order. And now there's all types of different loans that might be available. And again, depending on your particular situation, there'll be a certain loan type that's right for you. But there are two forms of bad credit loans. One of them is a secured loan, and the second one is an unsecured loan. So what's the difference? With a secured loan, when you think secured loan, think collateral, okay? So you're gonna have to put up some type of collateral to get this particular loan. And again, the reason that the bank wants security is because there's additional perceived risk if somebody has a bad credit score. Again, in their eyes, it's like, okay, there's a higher chance they're gonna default here, so let's require some collateral. So let's say you're like, okay, I want this loan, and you put up your vehicle as collateral. Well, if you don't pay on that loan or default on the loan, they'd be able to come after you and take the collateral to offset some of their losses. So a secured loan is better for the bank because it gives them more security and may allow them to give you the loan that you're looking for. Versus an unsecured loan. You see, with an unsecured loan, there is no collateral. And unsecured loans are much tougher to come by when you have bad credit. Because again, there's additional risk in the fact that you have bad credit. So depending on the size of the loan and also depending on the lender, an unsecured loan may be tougher to come by if you have bad credit, but it's not completely off the table. And again, on thesimpledollar.com, we talk about several lenders that can get you in an unsecured loan that we've already done the due diligence on. So make sure to check that out over on thesimpledollar.com. But once you've dialed in on the type of loan you're looking for, here are the steps that you're gonna wanna take before you actually start the application process. Again, many times folks get excited, they jump on a bank's website, they see the button to click for apply, and they just go for it without taking any of the kind of preparation steps that you want to take before you apply for credit. So I want to share those with you here. Make sure you're taking these steps before you just go on and apply for a loan. So the first thing to consider is that you need to truly evaluate how much money you need. Now, with bad credit, we know that there's gonna be additional fees. There's gonna be higher interest on this particular loan. So it's gonna be more expensive compared to if you had really, really good credit. So in this scenario, it is best to only get a loan for as much as you need. Don't take out extra and then just hold on to extra cash, because that extra that you're holding on to is quite expensive. Based on the fact that you have bad credit, there's gonna be higher interest on that amount. So only take out as much as you need. The next thing would be to check your credit score. So many people dive into applying for loans and lines of credit without knowing their credit, and they're stunned when they get denied. And honestly, guys, that's a tough thing for your credit report. You know, when you get hard inquiries on your credit, if you have too many of those, it can actually lower your score. So it's always best to have a fairly confident view that you're gonna qualify for a loan or a line of credit before you actually apply. So check your credit prior to beginning this process. And from there, once you've checked it and you're like, okay, you know, I got my 640 credit score, so I know I have bad credit, but I know exactly where I'm at, and I know there are lenders that will lend to me. Once you've reached that point, you can start putting together all the financial documents that they'll tell you in the application or on their website that you're gonna need in order to fulfill and complete the application. And with many lending institutions, number 3 is to get yourself pre-qualified for your loan. And this is where you find the lender that you're looking for that's going to give you the loan that you want based on your credit. And from there, what they do is they do a soft pull on your credit. And this is where they kind of take a peek at your credit without going through the whole report, so you don't get a hard inquiry on your credit. But they're able to see what they need to see to say, okay, John, you are pre-qualified for X. You are pre-qualified for this amount in a loan. And based on what we saw in the soft pull, these are approximately the terms that we'd be able to give to you. So when you're able to get yourself pre-qualified, it kind of lets you know in advance, what the numbers are going to look like, what the monthly payments are going to look like, how much this loan is actually going to cost you before you actually take out the loan. So get yourself, especially if we're talking about a mortgage or a large loan, get yourself pre-qualified with your lender before actually applying. Number 4 is actually apply and finalize your application. So if you've got yourself pre-qualified, you're satisfied with the terms that they offer to you, you can go ahead and finalize, go ahead and finish that loan application process. At this point, the lender will do an actual hard inquiry on your credit. They'll take the deep dive into your numbers, into any documentation that you provided to them to basically just verify everything you put on the application. And if everything is as it was stated, they will move forward and approve your loan. And of course, once you have the loan and you've made your purchase, the next step is to work diligently on paying this loan off. And now again, if you're starting with bad credit, you have a new opportunity here with this new loan to build your credit score and strengthen your credit report. So make sure that with this new loan, you treat this like gold and you pay this loan on time, every single month for the duration of the loan. If you are able to earn extra income and pay more towards the principal of the loan, you'll be able to reduce the loan balance quicker and pay off the loan faster, and ultimately saving you money in interest charges over the life of the loan. And again, make sure to check out the article that we did on this exact topic over on thesimpledollar.com. Hopefully you guys found value in this training and in this discussion. If you did, make sure to give this video a like and give it a comment below. And as well, subscribe to this YouTube channel. We are very serious about helping people that are on the journey to improving their financial literacy and getting better with their personal finances. So click subscribe, click the bell so that way you get notified on any and all of our future content. And I will see you in the next video.